Let me ask you about CareEdge Global IFSC. So, what is it? What does it do in the context of Care Ratings, the brand that we've always known as a ratings institution and company, at least in Mumbai?
Right. So you already said you know Care Ratings Limited as a second
As one of
largest,
3 rating companies in India and so on.
So it is the second largest rating agency in India, and it is the only domestic rating agency, which means we have no foreign ownership. So a thought was that how do we kind of expand our operations into the global space? And we've been in the ratings business for close to 30 plus years, you know, and we have a significant understanding of the domestic rating business. We have subsidiaries outside India. We have subsidiaries in Nepal. We have subsidiaries in Africa, in Mauritius and South Africa. So we've been doing ratings in those geographies also, all domestic rating businesses. So the idea is that why not, explore the international rating space. And the timing we thought was also right, because India, the way it's positioned geopolitically, is wanting to be the leader of the global south. And once you say that, you know, it's wanting to be that in very many disciplines. So why not credit rating? Plus, we are, if you look at internationally, also placed among the top 10 rating agencies in terms of the number of companies rated or the volume of debt rated, so on. If you look at emerging markets, and if I then say the subsidiaries of large rating agencies are counted within those rating agencies, then we are the largest rating agency in the emerging market. And that's why we thought we should have a foray into the global or international rating space. And that's why this company, you know, CareEdge Global IFSC Ltd.
And your primary business, at least at start, is sovereign ratings, which means you're actually rating countries and their their debt capability and so on.
Yeah. So when you say a global rating agency, we would be, our endeavor is to rate companies which are situated in any markets for their foreign currency borrowings, right? To do that, we will have to give a benchmark sovereign assessment, which is why sovereign rating. Now, sovereign rating is essentially, as you rightly said, a country assessment of the assessment of a country's ability to repay debt on time, plain and simple. But it kind of have a lot many more layers, you know. So it's not only ability to pay, otherwise, you know, India has never defaulted in the past, right? But it's also an economic, fiscal, monetary, institutions of governance, external debt quality, etc. The assessment is a little more broad based. And that's why we have to do this assessment to get a benchmark sovereign rating for a country. Unless and until we do that, we are not able to assess companies within the country, because a company rating will be, in a way, the threshold. It will threshold, or there will be a kind of upper ceiling to the company rating, which is a country ceiling.
Right.
You can get a 1 or 2 notches higher, but that's typically how it will be.
And we all know of Fitch and Moody's and S&P as the global rating agencies. So are there other rating agencies which are also global in the way you are trying to be global?
Yes, there are. There are close to 10 rating agencies registered with NRSRO, which is the licensing authority in the US. So apart from the names that you gave, there is also a Japanese credit rating agency, JCR. There is a Dominion bond rating agency, which is a Canadian agency, DBRS. There is a Kroll bond rating agency, which is the 4th largest in the US. So there are these names which are also there. But not all of them are not as big as the top 2 agencies in the country.
And you are also registered in this?
So we have right now a license in IFSCA. IFSCA is International Financial Services Center Authority, which is a new concept which the Government of India is propagating, which is an international financial service center outside of India. And this authority has powers of the central bank, the capital market regulator, the pension fund, and the insurance regulator. So it is a unified kind of authority. So they have given us a license to do global scale or sovereign ratings through IFSC ecosystem. So that's the license right now. So whichever companies are listed on the capital markets or the exchanges at IFSC, we will be the rating agency which will do rating. So they have made rating compulsory from 1st of October 2024, and from 1st of April they've made rating compulsory from an IFSC registered rating agency, which at present is us. So that's where it is.
So, would you be rating, let's say, a company in another country, which may
Yes.
not be, let's say, the United States or somewhere in Europe, but would you be rating those as well, or are you confined to IFSC listed companies?
So at present, so IFSC itself is trying to attract the other countries to get their companies listed on the exchange, and that's the endeavor. Really, it's like anybody and everybody earlier used to just go and rate in list in Singapore, and obviously all Indian companies used to list in Singapore. Then started the London exchange, and then they started to list dual listing on Singapore and London. But if you look at last 2 years, because of whatever other tax benefits and all the other incidental costs, 100% of the debt listings from India are happening in IFSC. Okay, they are also trying to get into other geographies, let's say Malaysia, Indonesia, or any of the Middle East countries, to try and tell those companies to come and list on IFSC for the benefits that IFSC offers. Proximity being one of them, second, cost being the other. So we expect that there will be listings from countries outside of India into the IFSC exchange. But yes, at present we are registered to rate companies which want to have a listing on the IFSC exchange.
But you could rate companies which are outside of this
we
universe.
could, absolutely.
And you might.
Yeah,
okay. So if do you therefore rate companies that are not in this universe in India? Or this is Care Ratings, which is your CareEdge, which is your parent company.
So two aspects. Any company which needs a foreign currency bond issuance cannot use Care Ratings India rating, because that's a domestic scale rating, because the investors are all investors outside of India, and they need an international scale rating or a global scale rating, which will be issued by CareEdge Global IFSC. So as we speak, we launched our services in October 2024. We've done ratings of 39 countries. Of which 24 are emerging countries and 15 are developed countries. We have also done 5 corporate ratings, 5 corporate bond ratings, 4 of which are already listed on the IFSC exchange. So, that's...
So which are these, the ones which are listed?
So there are a lot of NBFCs which are trying to access the global markets for raising funds. So so all of these are NBFCs which are trying to access the...
Got it. Yeah. Okay. So if the companies that are listed on the IFSC are presently raising debt, I mean, that's why you would raise them.
Yes.
So if I were to now focus a little bit on the sovereign side, how much resources do you put or devote to doing the sovereign rating of a company, of a country, which of course leads to the company-wise rating?
Yeah, so this is a very interesting question, because honestly, sitting in India, do I have the credibility, capacity to understand all the countries in the world? You know, when we say we've rated 39 countries, they account for 90% of the world GDP. So we've rated a whole lot of, and globally, if you see, 150 countries are rated. So when we kind of started this exercise, of course, we've built a large team, economics as well as rating, people who have rating understanding within our fold. And we then touch base with a lot of institutions, multilateral institutions, large governments, bodies. So all of them to understand the perspective on how to do these sovereign assessments. And, that's where, we engaged a lot of time we spend on that. Apart from that, we have a rating committee which actually assigns the rating, which has international experts. So we have, ex-chief credit officer of Standard & Poor's as a part of our committee. We have a chief credit officer of African Development Bank who is a part of our committee. We have a professor of Nottingham University specializing in economics who's a part of our committee. We have a leading economist from India who's been part of a large industrial group as a part of our committee. And we have an ex-CEO of a Caribbean rating agency as a part of this. So essentially, these are the 5 people who deliberate, discuss when a country is presented to them for a rating, and that's how the rating is assigned. What we want to do is draw upon their expertise so that we are able to do a fair assessment of the countries that we are doing. Now, if you look at how do we, the next logical question is, how do you really compare your ratings with some of the ratings which are given by the global rating agencies?
And as an extension of that, how much, let's say, clout do you have at this point, and where is that got going. Yeah.
Yeah, so I always say, to myself, this is like climbing 5 Everests. So cloud has to be built, honestly. But if you look at what ratings we have put out, the 39 ratings which I said, if I compare them with the leading rating agency S&P, then about 20 of them are same. 12 of them, CareEdge Global has a lower rating, and 8 countries, CareEdge Global has a higher rating, and one country, S&P, doesn't rate out of our basket. So there is a fair kind of dispersion of, and that dispersion is because of the differentiated methodology that we have evolved. What we felt when we looked at, and a little bit of history on this, sovereign rating started probably more than 100 years ago. But the present context which we are looking at is something which was developed, a methodology was developed in 80s. That's the context we're looking at. And when, the developed world looked at these ratings or looked at these countries, they largely were looking at countries which have reserve currency, which have, infrastructure which has built out, and also the benchmarks which got evolved, the methodology which got evolved, really focused on getting those aspects right. So when you look at their ratings, they get... definitely they have a very robust methodology, but they get the higher rating categories right. When you look at the lower rating categories and emerging economies and all, probably because they don't have proximity to these economies, they don't understand the nuances. That's where, you kind of feel that probably the ratings are not exactly aligned, or the methodologies are not as updated as they ought to be. So when we took up this challenge, we decided to look at this entire methodology piece afresh. And we introduce certain differentiators in the methodology, and I'll name a few of them. For example, when you rate a company, do you not consider the size of the company? Yes, you do. Some of these, or most of these, don't really consider size of an economy. So GDP, of the economy is not considered. We thought that's a very important thing in the economic pillar. So under the economic pillar, what is considered is per capita income and growth in per capita income by the global rating agencies, and per capita income not on a PPP basis. The question is, why not on a PPP basis? Because a dollar what you can buy in the US and a dollar what you can buy in India is far different. And essentially what you're understanding is the ability of the population to get you taxes in case the state decides to. That's what the per capita income should tell you, right? So if that's the case, then obviously it has to be on a PPP basis. So we introduce per capita income, but on a PPP basis. And we introduce all these three parameters, which is size of the economy, per capita income, and growth in per capita income. Why is that? Because if you look at, let's say, a developed economy like the US, size of the economy is large. Per capita income is also great, but the growth is lower. If you look at India, then the size of the economy, we may say it's the 5th largest, it's still developing, small. Per capita income is definitely small, and but the growth rate is good. So if I have to get a balance of the parameters within a particular framework, then I need all the parameters which counter each other, which is why we take into account all these three. So this is one example of how our methodology is differentiated. The second example is that we consider gross fixed capital formation, which is the investment that a country is making in its infrastructure. Why? Because this is the investment which will then increase the GDP of the country. And we found a very high correlation between high capital investment and future GDP growth. And that's something which is not a primary factor in many of the global rating agencies' assessments. And that we introduce as a primary factor. So, some of these are differentiated. There are a lot many, but some of these are...
So, are you being different because you want to be different, or you feel actually it makes a difference in the, let's say, in the way you assess a certain country or companies within that country?
So the examples which I gave you are pretty logical in terms of why are we making those changes or tweaks to the methodology. So it's not a question of whether we want to be different for the sake of it. I think it is a need of the hour to have a differentiated methodology, because if you look at world GDP, then 45% of the GDP will be contributed by emerging economies. If you look at governmental debt, then 34% of the governmental debt will be contributed by governments of emerging economies. And that's a very, very large piece. Shouldn't you really get the entire world view into a methodology? And that's where, we think that it's absolutely the need of the hour.
So as India thinks global and wants to be more global, including in, let's say, trying to have a reserve currency or something close to a reserve currency, you feel that the whole effort of having a homegrown but global sovereign rating agency sort of goes together and is a reflection of that?
Yeah, so, having a rating agency within your fold is like a soft power. It's not, so definitely...
And not too many countries have it, apart from the big ones.
Yes. Not too many countries have it. None of the emerging economies have it. I mean, Japan in Asia is a developed economy, so to say. China did try to do something in the space, but was not successful. So, because they kind of gave a very differentiated rating to their own country, and that's where, the effectiveness of the methodology really was questioned. So, we really don't want to do that. We don't want to be, seen as an extension of the government. We want to be independent. So CareEdge itself has resources to fund this particular venture, and we want to be seen as an agency which offers a differentiated view because it is a need of the hour and is independent. That's the positioning that we want to take. Yes, definitely, because we are from India and we have worked in markets like Africa also, we understand the developing and the underdeveloped market space. And that is something which will definitely be a kind of differentiator for the world to see.
Right. And sort of last question, as you grow this, let's say that the ratings business and it spreads, do you see that, firstly, of course, I mean, the first part of the question is, what are your India ratings looking like? Second, as you become more important and bigger, do you feel that there could be pressure, and how would you handle that?
So we've rated India BBB+. And I'll give a little bit of context to this also. It's a 2-notch difference from what the global rating agencies have given. But, for the first time, India was rated BBB- in 2004. And if you look at the GDP of the country has increased 5 times. If you look at the forex reserves, they have gone up by more than 6 times. If you look at the per capita income, that has grown as much. If you look at the banking assets, used to have NPAs of 7.5%, 2004, you are probably a gross NPA of close to 2.5 kind of range today. So if you look at policies, if you look at fiscal discipline, all of that has seen a dramatic change. India traditionally used to have high fiscal deficit, even today does have high fiscal deficit, but what is that money getting used for? It's getting used for gross fixed capital. It's getting used for capital investments. So that means it has a very positive GDP trigger that will get associated with it. So, taking all this into account, we have rated India BBB+. In terms of pressures on rating,
I mean, all agencies come under pressure, so you won't be alone. Yeah.
So, because we have significant experience of handling pressures, we've been in this business of 30 years. So we do understand that, and we would, I don't think that's a challenge at all. It's easily, it's a part of the business. It's a part of the business.
Great. Revati, it was a pleasure talking to you. Thank you so much.
Same here. Thank you so much.